Hi, this is Sea Beast. I want to talk to you today about Bitcoin and in particular something called the fee market. I've heard this term and used it myself without really understanding what it means. I can't find a definition for it in financial publications, so I'll presume that it's a word substitution that's meant to be something else. So let's try to figure out what it's supposed to mean, and I'll try not to use too much economic jargon. A market is the space of buyers and sellers used to determine the price of goods and services. The prices may be posted or the goods and services may be auctioned. There are many kinds of markets and auctions, but one thing they have in common is that price is agreed upon before money is exchanged. Then goods and service prices are compared by buyers and sellers to determine their fairness. Entities buying and selling services may or may not charge a fee. A fee is defined as a fixed charge for a service. The fee may be fixed by a flat amount or a proportionate rate. A variable rate may be used, but it's unwise to offer it without specific schedules agreed upon in advance. Buyers and sellers can then determine whether the fees are fair. Demanding a 35% tip on a meal when an 18% gratuity is customary may ask for a talk to the manager. Enter cryptocurrencies. At first, Bitcoin had no real value and no fee for transacting value. After a while, it did become practice to charge a fee. After a while, it was decided that fees should become a high priority for Bitcoin. Not long after that, Bitcoin fees were starting to get raised even after the money was transacted and then it didn't go through. This had the effect that the Bitcoin market could be more easily affected and manipulated. Not manipulated by the price of the goods and services, but with minimal investment in an attack called the replace by fee. Blocks could then be filled with spam transactions and the mining fees skyrocket. This skyrocketing fee creates so much unpredictability that blocks and mempools fill to the failure point where non-replace by fee transactions are forced to drop out. This is now a new financial phenomenon of purely speculative fees as entities unto themselves, with little relevance to the goods to which they are supposed to be attached. The transactions themselves are merely placeholders in the mempool real estate. Now it has become a market within a market. And how do you determine fairness? Some may not see it as unfair. The Bitcoin developers at Core claim that a tragedy of the commons is allowing the poor to spam Bitcoin real estate and ruin it for everyone. Therefore, only the rich are allowed to have a secure way to transact value, and the poor must suffer their tolerance. They claim to only allow rental use of Bitcoin at the pleasure of the wealthy and for the greater good. No compromise was even sought, because they enjoy wielding power for its own perverse pleasure. There are two ways to handle this iniquity. The first way is to simply avoid it by expanding the block size for transactions and fees. This allows fair market forces to create price discovery with no surprises after the transaction. Fees are once again restored to the role of the price of transacting goods and services. Devices like replace by fee become irrelevant. This is why Bitcoin Cash was forked from the original Bitcoin blockchain. The problem with this solution, while it depends on block size to handle most of the burden of growth, it's still untested at greater scales. A second way is to offer a fee market device that allows block size real estate to expand, but still protects investors from unfair market manipulation at some unforeseen expansion limit. Think of it like a postage stamp. At one time, postage stamps for first-class letters had the price printed on the stamp itself. Nowadays, there's a first-class stamp with no price. How is that possible? Forever stamps may speculate that the price of the postage will increase over time. It's kind of like a security, except that it has a specific use, extrinsic value, and nobody knows when it was bought or how much it went up. It only has the value of posting a first-class letter. And it doesn't matter how long you hold it, you can only use it once. And they are not divisible without destroying their unique purpose. Bitcoin miners have long accepted a minimal dust limit for transactions without combining them into larger valued outputs. Ethereum miners use a dust-like fee for transactions called gas. Gas is valued in fractions of ETH, but it fluctuates to the current price. Real gas in your car is usable for multiple trips in your car at the price you pumped it, irrespective of the current price. You should be able to buy a fee token like postage or gas that you can still use even after it goes up in price. Why not color a token that miners sell at a fee level? Imagine forever stamps that are one-time use but are sold at a protocol selected formula based on block reward, time, and difficulty divided by block size and a function of technology growth, or whatever predicts the best price of mining fee per byte. It can be traded as a separate token as long as the postage color is maintained, or it can simply be converted back to atomic units. The dust-like value of the fee stamp would be required by the protocol, but miners will gladly accept them and sell them because they're creating the value in the color. Not accepting them would be considered selfish and maybe silly because their face value will be probably a little higher than normal fee, but not worth the dust conversion cost by wallet holders. These colored postage fees would be bought through contracts created by miners. Of course, there would be backwards compatibility for adding the current fee price to transactions, but you could save money by buying the forever Bitcoins in bulk. Miners would take the speculative investment in the fee token as extra profit for coloring. Finally, the fee token can gain weight with age, so it will have additional protocol level inclusion power for long-term investors to get a higher priority with transactions. This would also help small blockchain investors that want an extra perk for investment in the technology. The weight can be used to give preference to miner participation that includes these types of fees. This solution may help mitigate the possibility of technology not keeping up with demand. It doesn't hurt the model of ever-expanding block size limits because it's only about the fees, not the transactions themselves. This can also be used by smaller blockchains because they can be used to create a firm relationship between mining and non-mining nodes as secondary remuneration. Non-mining nodes could become resellers of fee tokens, and even cryptocurrency exchanges could be used to sell them. So to wrap up, my understanding of a fee market is that it is a market within a market. Just like forever stamps or fuel, cryptocurrencies benefit from treating their tokens like a permanent commodity with intrinsic value. Fees benefit as a one-use, single-shot commodity with extrinsic value. And they both benefit from fair market forces. I hope you're able to follow this video. There'll be a link to a white paper down below, and I'll be happy to discuss this online in the future on Reddit and other social media. See you later.